Morning, everyone, and thank you for joining us today. I hope you're all enjoying our short spring here in Cleveland. I'm Cynthia Yang. I have Chelsea Hussey. My colleague are joining us today. You might be a little bit surprised that I'm not seeing Frank Fantozzi with us today. He had a foot surgery back in March, early March, and while he was taking recovery at home, he unfortunately had a fall and injured his shoulder, which led to another surgery earlier this week. The good news is that his surgery went really well and he's taking the time he needs to recover. So I will be stepping in to kick off today's presentation. Today, we will walk through what's been driving the market recently, particularly the geopolitical developments, the key economic indicators we're watching, and how we are thinking about positioning portfolios in this environment. As always, our goal is to help filter through the day-to-day noise and stay focused on what really matters for long-term investment decisions. Before we dive in, I do need to spend a few minutes covering some important disclosures. The information we're sharing today is for educational purposes only, and it reflects our view as of today. These views can change over time as market conditions evolve. You may also hear us referencing forward-looking expectations. Those are based on the current market assumptions. But as always, actual outcomes can be different. It's also important to keep in mind that this presentation is not intended as personalized investment decisions or advice or a recommendation to buy or sell any specific security. All investing involves risk, including the potential loss of principal, and past performance is not indicative of future results. We will also be using data from a number of third-party sources that we consider reliable, although not all of them has been independently verified. Lastly, just a reminder that diversification can help manage risk, but it does not eliminate. And different strategies may not be appropriate for every investor. If you have any questions about how any of this applies specifically to your situation, we're always happy to discuss that with you individually after the call today. With that, let's go ahead and kick things off with some of the key themes that have been on investors' mind recently. Let's start with one of the most immediate forces influencing the market today: geopolitical tensions in the Middle East and how they are impacting energy markets and overall market behavior. Since late February, disruptions in the Strait of Hormuz, which carries roughly 20% of global oil and liquefied natural gas supply, has created a significant supply shock. We've already seen meaningful real-world impacts. Oil production disruptions of approximately 7.5 to 9 billion barrels per day. Brent crude prices rising above $100 per barrel in March, and gasoline price tending towards $4.3 per gallon. As shown in the chart, both oil prices, the blue lines on the left axis, and the inflation expectations, the purple line on the right axis, moved sharply higher following the escalation. This is important because it's not just an energy story. It quickly fits into inflation expectations and broader economic growth. But just as quickly as market pricing the risk, they also began to adjust as expectations started to shift. When the ceasefire headlines emerged in early April, we saw a sharp reversal. Oil price fell significantly by as much as 15% in a single day. Equities rallied and bond yields declined. So what this tells us that markets are not just reacting to current fundamentals, they're consistently repricing based on changing expectations and uncertainty. That leads directly into what we're seeing across global markets. Since the escalation of conflicts in the Middle East, we've seen a rise in both sovereign yields and inflation expectations. That combination is important because it points to a potential stagflationary environment where the inflation rises but economic growth slows. Energy is really at the center of this story. And importantly, the impact is not uniform. It's creating a clear divergence between countries. The Strait of Hormuz is one of the most critical oil choke points in the world, and roughly 85 to 90% of the oil flowing through it goes to Asia, particularly countries like China and Japan, which are heavily dependent on Middle Eastern energy. So when there's disruption or even perceived risk in that region, it creates a clear divide. On one side, we have energy exporting countries like the US, Canada, and Brazil, which could benefit from higher energy price. On the other side, we have energy importing economies including Europe, the UK, and much of the Asia countries, where higher energy costs can slow growth while also pushing inflation higher. But here is a very important nuance about the US. Even though the US is technically an energy exporter today, we're still a major importer of the goods and services from other countries. So if countries like China, Japan, and others face rising energy costs, their production costs go up, and that eventually get passed back to us through higher prices on the goods that we consume. So over time, even in the US, this could potentially still erode the purchasing power and contribute to inflation, especially if the conflict persists. That's why this type of shock is considered stagflationary. It doesn't hit everyone equally, and it tends to widen the gap between the winners and losers across countries, sectors, and even households. From an investment perspective, it reinforces the importance of being well-diversified and intentional, because different parts of the market will respond very differently, depends on how this plays out. To bring this closer to home, these slides look at how oil price movement affect the US economy. On the left, you can see weekly gasoline prices across recent years. Gas prices are one of the most visible and immediate ways energy costs impact consumers, and they tend to influence sentiment quickly. Recently, we've seen prices move higher again, driven in part by geopolitical pressures. In the upper right, the chart shows a structural shift. Historically, the US was a net oil importer, meaning that rising oil prices act as a drag on the US economic growth. Today, following the shale revolution, the US is a net exporter, which can help support corporate profit and economic activities when energy prices rise. However, the impact is not evenly distributed. As shown in the bottom chart on the right, the lower income households spend a significantly higher percentage of their income on energy, making them much more sensitive to rising costs. So while higher oil price can support part of the economy, they can also create pressure on consumers, particularly at the lower end. The overall effect is what we call a K-shaped impact, where different groups experience very different outcomes. To put the current situation into perspective, it's helpful to look at how markets have historically responded to regional conflicts. This chart shows the long-term performance of the S&P 500 alongside major global conflicts. What we see is a very consistent historical pattern. Initially, markets react quickly to uncertainty. Equity stock market or equity often pull back, and investors shift towards safer assets like bonds. But importantly, those reactions are often short-lived. As more information becomes available, and especially if the conflict is contained, markets tend to stabilize and recover. This chart illustrates that pattern across multiple historical events. You can see that while there is often a near-term decline in equities, markets generally recover and refocus on underlying economic fundamentals. In other words, the initial reaction is more driven by uncertainty, but long-term performance is driven by earnings, growth, and productivity. That distinction is very critical. It suggests that while geopolitical events could create volatility and short-term dislocations, they rarely alter the long-term trajectory of markets unless they lead to sustained structural changes. So from an investment perspective, the goal is not to predict every geopolitical development, but to understand how these events affect market behaviors and to remain disciplined through periods of volatilities. This reinforces the importance of maintaining a long-term perspective even when short-term risks dominate the headlines. That brings us to the next section. Chelsea will walk us through the key signals we're watching over the next 6 to 12 months and what that really tells us about where market go from here. Chelsea, take it over.
Thanks, Cynthia. Good morning, everyone. Let's begin with looking at consumer spending. Consumer spending remains the backbone of the U.S. economy, so one of the key questions is whether the consumer continues to hold up or begins to slow more meaningfully. Recent data suggests that momentum is already moderating. Now, I'll note with this chart, this one goes back to 2023. Think about how much money was printed during COVID and the COVID recovery timeframe. So it is a bit natural that we would start to see a little bit of a moderation there as those balance sheets begin to shrink. But according to TD Economics, consumer spending growth has slowed down now to around 1.6% annualized, down significantly from prior periods. And when you adjust for inflation, real consumption has been relatively flat. What's particularly important is where the slowdown is happening. We're seeing a clear pullback in the discretionary categories, things like travel, recreation, non-essential goods, which tend to be early signals of changing consumer behavior. At the same time, there's an increasing divergence beneath the surface. Higher income households are still spending, supported by asset prices and income growth, while lower income households are more constrained. This K-shaped dynamic is helping explain why overall spending appears stable even as underlying conditions begin to weaken. So the path forward is not binary, it's conditional. If labor markets remain stable and income growth continues, we could see a gradual slowdown rather than a sharp contraction. But if job security deteriorates or inflation pressures persist, consumers may become more defensive, shifting from spending toward saving and balance sheet repair. From a market perspective, this matters because consumer behavior feeds directly into earnings, credit conditions, and policy decisions. From a portfolio standpoint, it reinforces the importance of diversification, particularly toward companies with resilient demand and strong cash flow characteristics, which tend to hold up better in a slowing consumption environment. Moving to the next section on credit defaults. Credit markets are one of the earliest indicators of stress in the system. While equity markets remain optimistic for a period of time, tightening financing conditions and rising defaults tend to flow through more directly to hiring, investment, and ultimately corporate earnings. What makes this cycle different is the shift from an extended period of ultra-low borrowing costs to a high-rate environment. As companies refinance debt at increasingly material higher rates, that creates pressure, particularly for low-quality borrowers. At the same time, we're seeing a growing dispersion within credit markets. On the left-hand side of the slide, you can see that investment grade and high yield spreads remain near historically tight levels, and that's supported by solid economic activity, strong earnings, and relatively low default rates. That said, if these tight spreads also leave less room for error, so if growth were to slow more meaningfully, those spreads could widen from there. On the right, the composition of the high yield market has also evolved. Today, over 50% of the high yield market index is rated BB, compared to 30% prior to the global financial crisis. This reflects overall improvement in credit quality, partly driven by riskier borrowers shifting to private credit markets. This table also reinforces the point: default rates remain concentrated with the lower rated CCC issuers, while overall defaults are still below long-term averages. So the key takeaway is this: credit risk isn't absent, it's just more selective. In our view, credit continues to offer attractive income, but outcomes increasingly depend on issuer quality, balance sheet strength, and underwriting discipline. In this environment, it's less about reaching for yield and more about being intentional, ensuring you're properly compensated for the risk that you take. Markets ultimately follow earnings, so this next slide is about understanding what's driving that growth beneath the surface. On the left-hand side, we break down the S&P earnings per share into three components: revenue growth, profit margins, and share buybacks. And what this shows is that earnings don't grow from just one source. They're both the result of top-line expansion and how efficiently companies convert revenue into profits. Historically, earnings growth has tracked closely with the economic cycle. After two very strong years in 2024 and 2025, driven by both revenue and margin expansion, expectations for 2026 remain constructive. However, as we move further out, there's noticeably more uncertainty, particularly given the evolving economic and policy backdrop. On the right-hand side, we look at profit margins. While margins declined briefly during the pandemic, they recovered quickly and remain near the high end of their historical average. Over the past 2 decades, we've actually seen structural expansion in the margins, largely driven by technology, scalability, and operating efficiencies. Looking ahead over the next 6 to 12 months, the key question is whether earnings growth broadens or if it remains concentrated. If consumer spending slows, revenue growth may moderate. At the same time, cost pressures, especially labor, could weigh on the margins if pricing power begins to fade. On the other hand, if there's continued efficiency gains, including from technology adoption, this could help support continued profitability. And this is also where expectations matter. This is a key takeaway we want you to remember if there's anything you leave with from today. Markets don't just react to earnings. They react to the gap between expectations and reality. If expectations are too high, even solid results can end up disappointing. From a portfolio perspective, this reinforces the importance of focusing on companies with more durable earnings power, strong balance sheets, and the ability to sustain margins across different environments. If earnings growth continues to broaden beyond a narrow group of companies, it can support more balanced market leadership and improve diversification. The last piece I want to cover with you is productivity. This is one of the most important and often underappreciated drivers of long-term economic growth because it determines how fast the economy can expand without generating inflation. What this chart helps illustrate is where we are in that process today. It compares the current AI investment cycle to past periods of major capital build-outs, including railroads, oil and gas, telecommunications, and post-war manufacturing. And what you see is that these cycles tend to follow a similar pattern. There's an initial phase of heavy investment where capital spending ramps up and expectations build, and that's where we are today with AI. But the key point is that productivity gains don't happen immediately during that investment phase. They tend to come later, after the infrastructure is built, when businesses begin integrating that technology into their workflows, improving efficiency, and scaling its use across the economy. In past cycles, that productivity payoff often took several years to materialize. So while markets may be pricing in the long-term potential of AI, the real economic benefits are still in the process of being realized. Looking ahead over the next 6 to 12 months, the key question is how quickly we see those gains show up in measurable ways, whether through improved margins, faster output, or more efficient use of labor. If productivity begins to improve meaningfully, it could create a very constructive backdrop, supporting economic growth while helping to contain inflation pressures. From an investment standpoint, this also broadens the opportunity set. It's not just the companies that are building AI infrastructure, it's the companies that successfully adopt and apply it that may become the next wave of winners. And with that, I'll turn it back over to Cynthia, who can walk us through some of these investment opportunities with a focus on AI.
Thank you, Chelsea. As Chelsea highlighted, productivity is really the bridge between what's happening in the economy and what's ultimately driving the investment outcome. And one of the most important drivers of that productivity right now is artificial intelligence. We continue to view AI as a defining structural theme, but what's evolving is how that theme is playing out in the market. We believe we are now entering what we would describe as AI phase 2.0. The initial phase was largely centered around software, models, and the companies building the technology. What we're seeing now is a shift towards the broader ecosystem, including power generation, infrastructure, data centers, industrial automation, and the physical build-out required to support AI at scale. So the opportunity set is expanding beyond a narrow group of large technology companies. That is exactly why we've developed our return on life, artificial intelligence, and technology thematic satellite strategy. As we moved into what we describe as AI phase 2, where the focus shifts from building models to deploying infrastructure and driving real productivity gains, the opportunity set is expanding significantly. This strategy is designed to provide targeted exposure to that evolving AI theme, but within a disciplined and diversified framework. Unlike traditional technology-heavy approaches, which tend to very concentrated in a small number of mega cap names, this strategy is intentionally broader in scope. We maintain a 70% domestic and 30% international and emerging market allocation, which allow us to capture global opportunities while maintaining a strong U.S. core. And importantly, the exposure spans multiple sectors, including healthcare, defense, energy, industrial, infrastructure, financials, and commodities. It reflects the reality that AI is not just a technology story, it is an economy-wide transformation. The focus is on companies that are benefiting from AI adoption, particularly through productivity gains, cost efficiencies, and the infrastructure required to support this transition. So rather than concentrating solely on large tech platforms, we're emphasizing what we call the picks and shovels beneficiaries of AI expansion, the companies enabling the build-out of this ecosystem. The objective is to enhance long-term return potential while avoiding excessive concentration in a small group of stocks. Overall, this approach allows us to participate in the AI theme in a thoughtful and diversified way without becoming overly reliant on a narrow group of stocks. Importantly, this is implemented as a satellite strategy designed to complement the core long-term portfolio we build for our clients rather than replacing them. Depending on your specific investment objective and time horizon, you may or may not have exposure to this allocation. What we've just discussed is how we are positioning portfolios to capture the AI opportunity across a broad and evolving ecosystem. But to really understand the significance of this theme, it helps to step away from market for a moment and look at how AI is already changing people's lives in a very real and tangible way. So let me share two stories in healthcare where the impact is not just incremental, but truly transformative. Ann Johnson was a high school teacher who lived in Canada, where she taught math and physical education and coached sports. She had just got married and had a young child. Then in 2005, at the age of 30, everything changed. She suffered a brainstem stroke, which left her almost completely paralyzed, a condition often referred to as locked-in syndrome. What is especially difficult about this condition is that her mind is fully intact. She could think, understand, and form words, but she lost the ability to move and to speak. For years, the only ways she could communicate was through a very slow methods like eye tracking or tapping letter by letter, often just a few words per minute. She had a daughter who was just a year old when the stroke happened. Her daughter grew up never hearing her mother's real voice. That all changed with AI in 2023. Researchers at UC San Francisco and UC Berkeley developed a brain-computer interface that could capture the signals in her brain when she attempted to speak. They trained AI models to decode these brain signals into speech in near real time. And even more remarkably, they used old recordings of Anne's voice, including a speech from her wedding, to recreate a synthetic voice that sounded just like her. So instead of speaking through a robotic or genetic voice, she could communicate in a voice that reflected who she was. After nearly 18 years, she was able to hear her voice again. For her family, especially her daughter, it meant hearing something they hadn't experienced in almost 2 decades. This is a profound shift. We're not just improving communication, we're restoring identity, connection, and human interaction. And AI is a key enabling component that makes this possible, translating brain activities into natural language and even recreating something that as personal as a human voice. From an investment perspective, this highlights that AI is not just a technology story, it's driving innovation across healthcare, neuroscience, and entirely new category of treatment with real life-changing outcomes. The second story I would like to share with you is about KJ. KJ was a baby boy born in Philadelphia in 2023. Shortly after his birth, doctor realized something was seriously wrong about him. He had dangerously high ammonia levels in his body, a sign of a rare disorder. In simple terms, his body could not properly process protein, causing toxic ammonia to build up and affect his brain. Without treatment, this condition can lead to severe neurological damage or even death. Historically, managing a condition like this is incredibly difficult. It often requires a lifelong medication, a highly restrictive diet, and in some cases, a liver transplant. But one of the biggest challenges is simply identifying the root cause. There are hundreds of possible genetic mutations that could lead to similar symptoms. And traditionally, diagnosing the exact issue can take weeks or even months of testing and analysis. In the case like cages, time is very critical. This is where AI began to make a difference. Using advanced genomic sequencing combined with AI-driven analysis, doctors were able to rapidly scan and interpret his genetic data, pinpointing the exact mutation much faster than traditional methods. Instead of a prolonged process, they identified the root cause in a fraction of time, and that speed made all the difference. Once they understood the problem, they turned to a breakthrough technology called CRISPR. The simplest way to think about CRISPR is like a pair of molecular scissors. It allows scientists to go into the DNA, locate the exact spot where there is an error, cut it out, and potentially repair it, addressing the problem at its source rather than just managing the symptoms. In KJ's case, doctors extracted his cell, edited the faulty gene, and reintroduced those corrected cells back into his body. And the early results have been incredibly encouraging. For the first time, his body began processing ammonia more effectively, something that previously wasn't possible. For his family, it meant hope in a situation that had very little of it. This represents a potential fundamental shift. We're moving from a world where diagnosis can take months and treatment focus on managing the symptoms to one where AI help us rapidly identify disease. The technologies like CRISPR allow us to target it at the source. And just like in Anne's story, AI is a key enabling component, accelerating discovery, improving precision, and making these kind of breakthroughs possible. While those examples are in healthcare, the impact of AI extended far beyond this space. We're seeing similar transformations across industries, from industrial, where AI is improving efficiencies and automation, to financial services, where it enhancing the decision-making process, risk management, and personalization. The reason we chose those healthcare stories is because they're much more tangible. They show in a very real and personal way how AI can directly impact an individual's life. But the broader takeaway is that this same underlying technology is reshaping how businesses operate and how values is created across the entire economy. And that is what makes this such a powerful long-term theme. So if we zoom out from those examples, it's really bring us back to a few key takeaways we want to leave you with. First, while the geopolitical events could drive short-term volatility, markets continue to be driven by underlying economic fundamentals over time. Second, the economic outlook remains balanced, with areas of resilience but also signs of slowings, which reinforce the importance of diversification and selectivity. Third, artificial intelligence remains a defining structural theme, but the opportunity is evolving. We're now seeing a shift towards broader adoption across infrastructure, healthcare, industrial, and financials, which expand the opportunity set beyond a narrow group of companies. And finally, how we implement that theme matters. Our approach focuses on capturing the AI opportunity in a diversified and disciplined way through a satellite strategy that complements core portfolios without introducing excessive concentration risk. Well, we hope this discussion has been helpful in providing the perspectives on both the current market environment and where we're seeing opportunities. If you're interested in learning more about how the AI strategy may fit into your portfolio, feel free to give us a call and we'd be happy to have that conversation and tailor it to your specific investment objectives and time horizon. With that, it concludes our discussion today, and we're opening it up for any questions.
While you all are coming up with your thoughts or questions that you'd like to share with us, we thought it would be helpful to go through a couple of the frequently asked questions or discussion topics that we've been having with clients recently, and see if that brings some value as well. So the first question that we've been getting a lot is, if the current situation in the Middle East were to escalate, what would you be watching first to understand the potential impact on the markets? And again, some of this ties back to what we discussed earlier, but the big one I'd watch first is the energy flows, especially in the Strait of Hormuz, then oil, shipping, and financial conditions. Markets can handle scary headlines way better than they can handle a persistent supply shock. So the main thing we're watching is whether or not it turns into a real disruption to energy supply versus concerning headlines. If oil and natural gas keep flowing, markets usually tend to stabilize. If those flows are disrupted long-term, that's where it can start showing up more broadly, and that's in inflation, consumer spending, and market volatility. And that's why in our process, we're always tying it back to those key indicators that we discussed before: consumer strength, credit conditions, and earnings, rather than just reacting to headlines alone. Another question we often get is how higher oil prices tend to contribute or show up in other areas of the economy, particularly in areas that investors might not immediately think about. Obviously, the key place where we all feel the pain is at the gas station. But there's a little bit greater context to that, and a greater story, which is the overall tax of that on the economy. This raises transportation costs, freight costs, air travel costs, and other industrial input costs, and that can affect also chemicals, plastics, packaging, and even fertilizers, liquefied natural gas energy prices, and it's all because of the same regional choke points. They all matter for more than just crude oil. The second layer where we see this is in inflation. Obviously, we know those energy shocks feed into broader inflation, especially when the shock is large and persistent enough to influence those production costs, as well as wage demands and inflation expectations. One underappreciated channel right now is logistics and insurance. The IMF has noted that maritime insurance premiums have surged and routes have lengthened, which means some of the pressures will show up in delivery times, supply chain efficiency, and import costs before investors fully see it in the headline inflation data. That's why we pay so much attention to areas like consumer spending and inflation, because energy can quietly influence both of those. Another question we've been asked recently is, when it comes to geopolitics, do we tend to see more separation across sectors, or does it impact the market more broadly? At first, it's usually relatively like winners and losers story. If it persists, it becomes a broader market story. But early on, it's more of a sector story. So early winners might be energy and defense, while things like airlines or transportation, those can obviously begin to feel the pressures from those higher costs. If it's short-lived, it tends to stay pretty contained among those different sectors. But if it persists and starts impacting inflation and growth, that's when it becomes the broad market issue. And that's one of the reasons why we focus on broad sector exposure and diversification so much. So we're not overly reliant on any one outcome. Another question we receive often, let's see here. Yeah, are there any ripple effects from the current situation in the Middle East that you think aren't getting much attention right now? This is an excellent one. The less discussed risks, and I've alluded to these prior, are liquefied natural gas, fertilizer and food costs, and then the knock-on effects in shipping, insurance, and in air travel. First, it's the natural gas. That piece powers markets, energy importing countries, utilities, the power that generates so many of these countries. That's obviously a huge piece there. The second being the fertilizers and food segment. The World Bank has highlighted that fertilizer is a huge part of that transmission channel, which means that ripple effect can move from energy to agriculture and food security, particularly for more of those more vulnerable importing economies. The third would be services and transport. The fallout here is not just about commodities, it's air traffic at major Gulf hubs that's fallen sharply, and the region's tourism, re-export, logistics, and transport ecosystems have also been hit. So the spillover is pretty wide there. And those are areas that we've noticed aren't getting as much of the headline attention, but are certainly impacted by all of this. Another question we've had is, at what point would the ongoing geopolitical tensions and higher oil prices begin to meaningfully impact corporate earnings? A brief oil spike is usually manageable. The sustained one is that's where it really matters, where companies can no longer pass on those increased costs without hurting either their margins or their overall guidance. So I'd be listening personally for 3 signs during earnings season. One, seeing if there are more companies talking about margin pressure from fuel, freight, and other inputs. 2, if there's weaker guidance versus just weaker past quarter results. And 3, signs that consumers or businesses are becoming more price sensitive. That's the point where this shifts from market volatility to a more durable earnings headwind. So we're watching things like earnings and company outlooks, not just oil prices themselves. In terms of earnings trends and those further outlooks, I'd actually like to pivot to Cynthia for a couple specific questions that I'd like her to answer for us about our AI and thematic technology strategy. And the first one I'd love for you to share is how do you determine when it makes sense to introduce the strategy into a client's portfolio versus just continuing to watch the theme develop?
Thank you, Chelsea. That's a really great question. And this one we've been spending a lot of time really thinking about and discussed internally. One of the key things that we look for is whether a theme is still conceptual or whether it's already showing up in real, measurable ways. In the case of AI, we're clearly seeing tangible evidence. The revenue growth and earnings expansion from large technology companies, particularly the hyperscalers, are strong indicators that AI is no longer just an idea in the lab. It's beginning to commercialize and materialize. It's driving productivity and it's already impacting how business operates and how we live from day to day. And because of that, we believe waiting for the same to fully develop could mean missing a much more meaningful potential of that long-term growth. That said, timing and implementation still matters. We spent over 2 months conducting our due diligence, doing in-depth research, and having both internal and external discussions before we built out our AI and technology thematic strategy back in January this year. Even then, we were very deliberate in how we implemented. The strategy was designed as a satellite allocation to complement our core portfolio, not to replace it. So we didn't really feel the need to rush into this thematic satellite strategy at elevated valuation level. When we saw the market pulse back in March, that created a more attractive entry point for us, and we began putting that satellite sleeves to work towards the end of March. So ultimately, it's about balance, participating early enough to capture the long-term opportunity while remaining disciplined and opportunistic in how we build exposure over time.
Fantastic. A follow-up to that then, given how much attention AI has received, how do you evaluate what might already be priced in versus where there's still opportunity?
Oh, another really great question. And to think about it, I think it will be helpful for us to step back from where we are today and look at the previous waves of innovation. And for those audience who had been with us last year in our April market noise, you may recall that we shared a story about Ford and the introduction innovation of its assembling line back in early 1900. At that time, it was a major breakthrough in productivity. Cars were once took about 12 hours to build, could all of a sudden be produced in about 19 minutes. Naturally, many people assumed this would lead to fewer jobs because it took less time and less labor to build each car. But what actually happened was the opposite. As the production becomes much more efficient, costs came down significantly, cars became more affordable, demand picks up, and Ford, including other auto companies in the broader auto industry, ended up hiring more workers, not fewer. So that really tells us a really good story of how innovation and productivity can not only help the company's profit margin itself, but also help the employment market. And the ripple effect did not just stop from there. As more people own cars, mobility increased in a way that were very hard to imagine at the time. For example, visits to ski resort increased nearly tenfold, not because skiing all of a sudden becomes more popular, but because people now had the ability to travel a few hours away from home for a weekend trip, which simply wasn't practical before. So a single innovation didn't just improve one industry. It reshaped behavior, it created new demand, and unlocked entirely new economic activities. I think AI is at a similar stage today. Yes, some of the near-term growth expectations are likely already reflected in today's market valuation. And as we've seen, market today are very sensitive to expectations. There's less room for errors, and investors are less patient for long-term growth in the next decade or two. They're expecting more of a short-term profit. Well, even those companies deliver the strong result could potentially see a pullback if they fall short of the market or the investors were anticipating. So just be aware of that. Short term, it might mean a little bit more volatility in the market, but still, we're still in the very early stage of this AI, and how this technology will ultimately be applied across different industries, what would be the second and the third order effect might look like, is still very hard to imagine and hard to believe that all that long-term growth has been priced in today's market.
Great question. We had a couple others in the Q&A. One, quite a technical question. I'm assuming that came from someone with a very strong engineering or a computer science background. We did our best to answer that one. There's another one that I thought might tie back to what you were talking about, Cynthia, with the picks and shovels method of our overall AI strategy. That question was, is there a concern with the rapid evolution of AI adoption as it pertains to the construction of new data centers and the huge amounts of power and water that they require, putting a big strain on consumer power consumption, and then, of course, addressing, there's a lot of local pushback within communities pushing back against some of that new data center construction.
I mean, it's a really valid concern, and we start to see pushbacks, and even some of our clients who are much more yield as focused in terms of their investment are starting to concern about, yes, I get the idea of how wonderful AI could help us with our daily lives, help us with the company's productivity. But at the same time, there are other concerns about, okay, if that's going to drive up the electricity price that everybody that have to pay, that's going to push up our energy bills up. And another concern is really water has been used a lot to cooling down those data center. And with them consuming more water to cooling down the data center, how is that going to impact our daily life and our environment? Those are all very legit and valid concerns. And we see there are companies out there who are finding ways to maybe help to limit or reduce the impact either on the environment or the energy price. There were discussions about a couple of companies were trying to build the local data center and building their internal generators and finding other ways instead of using the energy companies more supporting our consumers' assumption. So I'd say that short term, we might be able to see a little bit disruption about how it's going to impact our personal and energy bills. But long term, those companies were looking for different ways, more innovative ways to finding energies to support their data center. And another discussion that has been going on for quite a while was nuclear plant, that the countries, the industries were looking for other sources of supporting the massive energy demand that those data centers are looking for.
Great answer. All right. Any other thoughts, questions? All right. As Cynthia said, if there's anything you think of even after our seminar concludes, please feel free to reach out to us. Let us know how we can help you or what you'd like to discuss further. With that, we can conclude here and continue on with our days.
All right, thank you very much.
Yep. Thank you all.
Take care. Bye.